Welcome to Caserta's Data Intelligence Series. In this series, we talk about what it takes to go from a good data and analytics leader to a great one. We'll share with you the tools and methodologies you need to build better, faster, and more robust, as well as strategies and frameworks to generate more revenue and grow your business. Featuring some very special guests and experts to inspire you and give you advice and direction on your data journey. And now, introducing your host, Caserta Data and Analytics Evangelist and VP Marketing, Remy Rosenbaum.
Hey there, fellow data and analytics aficionados, and thank you for joining me today in our episode of Caserta's Data Intelligence webinar series. I'm your host, Remy Rosenbaum. And data and analytics leaders, we're faced with a myriad of challenges under our tenure, but one particularly daunting challenge seems to take the cake: mergers and acquisitions. And it's because all too often during the M&A process, a comprehensive data strategy is at best insufficient and at worst non-existent. I was at a conference, this was probably right before COVID hit, giving a talk about data-driven healthcare. And the CIO of the hospital system lamented to me that through M&As in their healthcare system over the years, they have more than 50 different electronic health records. And because of that, there's a lack of interoperability issues and a whole multitude of inefficiencies in the system. We don't want that to happen to you. So to better understand the key considerations and challenges for data leaders during mergers and acquisitions, I've invited two excellent presenters, panelists, Danny Siegel and Joe Caserta. Danny has been leading enterprise-scale data analytics technology innovation programs in both reporting, analytics, and transactional applications for more than 25 years. His experience in data management, data governance, and creating and delivering decision-supporting ML AI solutions spans leadership roles at numerous Fortune 500 companies, such as Coty, Avon Cosmetics, Pfizer, PricewaterhouseCoopers, Acer, Science Applications International. And currently, Danny leads the global information management and data services at Newell Brands, which is among the largest and most diverse CPG manufacturer and distributor in the world. That's a lot, Danny. You have a illustrious history. And also we have our very own Joe Caserta, who is an internationally recognized public speaker, entrepreneur, technologist, and founding CEO of Caserta. Joe co-authored the Data Warehouse ETL Toolkit, which is still an industry best-selling book that has become the standard for preparing data for analytics. Joe is recognized as an authority on enterprise data analytics and continues to innovate and expand his role within the industry. Caserta remains at the forefront of the data analytics revolution, devising the most unique and advanced environments in use today. So a little bit of housekeeping and then we'll get started. Caserta, if you don't already know, is a professional services firm. We are laser focused on data and analytics engagement. We deliver strategic assessments with actionable roadmaps, craft innovative designs and architectures, and perform advanced implementations that leverage the latest technologies and proven methodologies and frameworks. Our teams are led by data scientists and data engineers who share a relentless dedication to solving our clients' data and analytics challenges fast. I will send you a recording of this webinar to the email address you provided. And if you have any questions during the webinar, I encourage you to ask them and we will have them answered. So enough with the housekeeping. Let's get started. I will start with you, Danny, and Joe, you'll chime in after. What is the biggest mistake that you have seen data leaders make during the M&A process?
Thanks, Remy, for the generous introduction. So in terms of mistakes, the one that's easiest, and I probably gave some of that thunder away in the small intro we did together just the other day, is not being involved. So so much of M&A happens, at least in my experience, behind in sort of secrecy almost. I don't want to say they're handshake deals, but they're deals that get discussed solely on their financial merits or perhaps strategic merits. Very rarely does someone, whether it's the CIO even, or someone below that who has more, I'd say, intimate knowledge of data operations, really understand and get involved in the deal process. So, key mistake is you don't hear about it, you don't get yourself involved, you don't try to insert yourself at that table. let's say, for the sake of argument and being a realist here, most of the time we as data leaders, I'm assuming some of the folks participating would fit that moniker. We don't get involved. We usually find out a bit after the fact, perhaps before the transaction is consummated, but between the time that the deal is actually made and the time that any sort of integration takes place. The mistake then, I think, is simply not starting to ask the tough questions. What do we want to do with the company? Does the data matter to us anymore? There could be actual monetization value in the data that's sitting in the acquired entity, or for that matter, in an entity you're trying to divest of. So starting to ask the really difficult questions, and then, of course, putting a quick plan together to either incorporate that data or what have you, whatever the right sort of disposition end state sort of needs to get to. So that's kind of the key mistake, is ignoring it or not getting involved at all. What do you think, Joe?
Yeah, I think one of the mistakes is, again, early on, kind of like what you said, during their due diligence process, when you're looking to acquire a company, but mainly it's focused on the state of the business, the health of the business. They do forensic accounting. They look at, all of the key metrics like attrition and retention of employees. Like all of that is like measured and scorecarded and is input to the valuation of the business. But the data, like the health of the data ecosystem, is generally overlooked. Is there a data warehouse? Is there an MDM system? If there is, what domains are being mastered? What is the integration effort going to look like when you do decide to bring that company aboard? Things like, is there any consolidation? Like at what level is the financial reporting? And if it is consolidated, at what level? And, how easy or hard or difficult is it going to be to integrate with the parent acquiring company? And, it's, and then all of the people, is there a dedicated team for data? Is there a CDO for data? And how is that going to look, coming in? Are they going to have to, is it going to be, we've had clients where they just finish an M&A process. They're all integrated from a business perspective, but they've been working on their data integration for 3 years and they're not finished yet. It's because they just like drastically underestimated the effort. It's not a trivial effort. There's a lot to think about, and hopefully through this session we'll get through those things that you need to think about.
So totally agree. I was actually because I was going to say something you said, Joe. You just nailed on a great one that I experienced firsthand around understanding how deep you need to go in the financial, because often these things are judged initially on their merits based on their financial performance. So understanding the full kind of revenue and cost structure of that business. Do I care about it at the very lowest, atomic level, or is it okay because I'm gonna really migrate those operations? I literally went through a very large acquisition where we, after the fact, realized that we simply couldn't plan effectively. Planning was migrating from very large systems to spreadsheets because the source systems for planning and for all of the what I would call EPM, or enterprise performance management for the acquired entity, simply was cut off. They said, you didn't buy this thing, so stop. We had the data, but then we had to do this really rapid mapping exercise so that even understanding like for like financials as we crossed the sort of finish line into operating as a combined entity was a measurable thing. Now, in that case, it wasn't one of those situations where we're just looking at it and say, let's treat it as a standalone entity. They were getting incorporated quite quickly. And I think there was some real oversights, if you will, on how to address simply the financial performance. And that doesn't say anything about the marketing costs and product attribution and so forth. I mean, all of the master data that describe the business.
That's right. That's right.
So let's talk about that long-term strategy. What key questions should data leaders be asking their own company as it relates to the long-term strategy of the combined company?
Yeah. Well, I think so. let's start with the acquired, because you have both sides of a transaction. Sometimes we often live on both of them. They can both be pretty painful if you don't handle them right. So on the buy side, I think some of the key early questions are, I mean, quite obviously, I suppose, is, are we going to integrate this thing? Is this not, on day one, we're going to start a robust exercise in getting that operation combined into the combined operations of the acquirer. That's one discrete sort of path, right? It's a little more project driven. You probably need some bridge type of technology to help you until you get it fully integrated, because that doesn't happen overnight. At the other end of the spectrum, and this is a choice a lot of companies make, saying, for example, if you're buying a company for its intellectual property and you're not necessarily concerned about, you're going to kind of continue to let them operate as a standalone entity and incorporate their financials, nothing more, right? In those cases, well, that's okay. There's probably not a ton of data integration. It's a fairly light touch. Maybe as simple as rolling up financials and doing the mapping between the financials. So at the end of a period, if you're a public company, you can report on them from a statutory perspective. So that can be quite, I want to say it's simple. It's relatively simple. And there's 100 shades of gray in between. Sometimes you have functions that are collapsing, but you're still going to leave some operations as standalone, and vice versa. You could have things where you're actually breaking them out. On the other side of that scenario, Remy, so like if you're the seller, big consideration, are you going to have to operate this thing? So what's the strategy of the person you're selling to, right? Are they going to take it and incorporate it? Well, then you probably have some transitional service agreements you'll have to look up to for some time until they finish their own data integration. And you have to be prepared to answer a lot of questions and sit through a lot of workshops to explain the way the data works to them. They're newbies to your business. You have to sort of almost treat them like a new employee in a sense. And then, again, at the other end of the spectrum, if they're going to treat you as the seller as more of a standalone entity, well, that's okay. There's not a lot to do, but just be prepared for putting a security ring fence around the data that should be available to them, so that the rest of your business, if there's parts of your business that are going to continue to operate independently, they shouldn't have access. They shouldn't be able to see that. So it's almost like creating that clean room of operations for that TSA to operate in. What do you think, Joe?
Yeah, the key thing that you said was, like, is the decision going to be, are we going to let this company run autonomously, or are we going to try to integrate them into our enterprise? Yeah. And it's never an obvious answer. And it's not always, an honest answer either, right? The acquired company and all of its employees are usually told one thing, but there's usually like a grand master plan that is not always shared. It's usually shared later in time, right? And that's to not make everybody panic, right? It's a fair thing to do. But at the end of the day, you need to be able to, as a data person, you need to know that information. You need to know things like, are we going to try to integrate our parts inventory? Are we going to be able to integrate our marketing efforts? Are we going to have to integrate our customers? And because those are huge efforts that have to either be done now or 3 years from now. Eventually, they probably have to be done, right? So asking that question and being honest with yourself and being honest with the data folks on both sides of the equation is really important for success.
Yeah. You nailed a couple of good ones there, actually, Joe. One of the things you mentioned is customers, which I kind of failed to mention. If you're buying someone that's in a common industry and you have common customers, there's few things more frustrating to a customer than have to do, essentially do business with you as an acquirer in two ways for any extended period of time, basically making their lives more difficult, if not your own. Suppliers, same kind of thing. You define them very differently. You'll find very quickly that you have different payment terms. You have all kinds of there's the contractual aspects that are typically considered in a little bit more detail, even by the say classic M&A types that are doing due diligence. But unwinding that can be you know, highly immaterial in terms of effort, if not legally challenging, depending on the size and scope of the agreements.
Yeah, and you know, when we talk about, you know, I think we're gonna the theme of this session is you have to figure out at what level of granularity do you want to do the integration, because it's great to do financial integration, right? But if we are going to have shared customers, right, then the customer's experience needs to be holistic. That means all the transactions that occur with the child, with the acquired company, and all the transactions that are done with the acquiring company, they need to be aligned, right? So that you have the whole customer 360 view. And that's not trivial, you know, and lining those up across all the different ways we interact with customers, it's a non-trivial effort. And you have to decide, you know, pretty upfront whether you want to do that or not, because as you said, Danny, if you don't do it, and you are, if the businesses are aligned, but the systems are not, you're going to wind up with some unhappy customers and wind up with some attrition.
Yeah, exactly.
So let's get some resolution there. What are the various approaches to the transition of data in an acquisition or in a divestiture? What can you tell us about that?
Well, I think, you know, at the one end, I've seen situations where it's simply a one-time conversion exercise with an end date. So any data, say, going from the transaction date 2 years prior gets converted to a common data standard with your existing information, and therefore, and at the, as Joe mentioned, at the level that's appropriate to measure that business, and the operations sort of flows naturally after that. That's one way to do it. So a simple data conversion. The other way is perhaps almost treat it like a new implementation of a new business inside, like if you were creating a new brand, let's say. New products, you might have new sales force for it that has to get defined. You know, communications with customers about how you're going to transact with them. In the case of consumer products, could be new vendor IDs if necessary, and new ways of communicating. But setting up all the products, making sure that they have all the right kind of attribution for you to actually produce them, setting up the financials correctly. If you know, again, not just the level, but you might have different aspects in your gross to net flow that the new business you're buying is slightly different than yours. Well, you may have to really rethink or expand your financial code blocks and so forth to accommodate for it. So making sure that your standards actually can accommodate that business, I think, first and foremost. Setting up all that master data, you know, and then of course the acquired entity training all the people to use all that data in a new way and to transact in your systems. And I'm giving you the most, I would say, aggressive and perhaps rare circumstance where you're going to really fold the business in. And I've been party to one of these, a big one. And
what's about that?
It is. What's it? Yeah. No, well, when I was with Cody, we purchased a big chunk of a P&G business, and the edict was on day one after the transaction, we were going to operate. We had some TSA. There was a complete flip overnight. But the thinking was they would operate as we collectively would operate as a single entity, including the factories and the distribution centers and what have you. Well, what that felt like, honestly, was like the implementation of a couple new ERP systems, coupled with dozens of warehouses, coupled with, half a dozen factories all at once. Which is a massive, hundreds of people involved over the course of 12 to 18 months. So, I mean, that's this. Now, this is just to give you a sense of scale, about a $12 billion acquisition. So, giving you gross size, sometimes size, complexity don't exactly align, but the complexity was very high. So, just to give you a sense, I've seen very, very simple transactions, much larger ones. When I was at Pfizer, we did a $40+ billion acquisition of a company called Pharmacia. A lot of that was just mapping, not a whole lot of integration. We kept most of the facilities and the systems in them, But from a financials perspective, we had to spend a small amount of money, but making sure that we did a one-time data conversion so we could actually manage and understand the flow of that business going forward, primarily for financial projection purposes, and to make sure that we could. There was some trade aspects where they had to keep track of, how much was being spent in certain categories that we had to communicate back to the government. So there was a statutory aspect as well. But that's the other firewall. So some can be quite simple. And if you think about it, in the pharma business, you're buying IP by and large, right? Particularly when you're coming from a Pfizer, they owned half the landscape at the time. And I mean, I can't imagine there were too many doctors that they weren't talking to, or distributors they weren't working with. So wasn't so much about the, ripping up the floorboards with customers, very much about integrating the IP and the revenue. So kind of gives you a sense. It can go a lot of direction, but it would take more than an hour to go through every permutation of that. But those are some of the extremes.
I think all really, really good, good like war stories. I love that. But there's basically like the way I think about it. We've done a few of those that you talked about together, and there's basically three categories I like to put this into. Right? There's like either you're leaving everything segregated transaction systems, segregated reporting systems, right? And that has happened. And if you're not a public entity, that's okay, right? You could be privately owned and acquire companies and let them run autonomously and have all of their reporting and analytics and transaction systems separate. That's okay. Another way to do it is to have your transaction system segregated, but all of your reporting integrated, right? And that happens. And that's usually like a baby step, even if you don't get to the third one, which I'm going to recommend. But that one, transaction systems stay the same. And then, all of the reporting, you have to go through all of the diligence of integrating all of that data at some level. Even at the atomic level, sometimes you're not going to touch the transaction systems and how they work, but you need to, for reporting purposes, align all of your domains and all of your codes basically within the organization so that you can do holistic reporting as a single entity. And then the third one is integrate all your transactions and integrate all of your reporting. When you do that, so number two, right, systems stay fairly easy. The reporting gets really hairy, right? That integration process is super complicated. The second one, the integration of all of the systems, super hairy, very complicated. But then the reporting is basically modifications of the master reports that you already have, right? So it really, you have to figure out like, what is it that you want to try to accomplish? For what purposes? Are you public? Are you private? Right? Who are you reporting? Who's the reporting going to? And how are you going to function as an entity when this M&A deal is done? Is it okay to leave things separate, or do they need to be integrated in order to function?
That's excellent. And we have time for one more question. And it is a dramatic one because I like the stories. What kinds of things tend to go wrong in the handoff? And this is, of course, when companies don't use Caserta to help them with their data and analytics, mergers and acquisitions. So Danny, what kinds of things tend to go wrong in the handoff?
Well, so it is a bit of a meatball question, I think. Yeah, there's so much that can go wrong. Everything from a misunderstanding of the source data, right? So you kind of don't get enough runway to really map things correctly, and you find that you are in fact misrepresenting performance because you haven't aligned the data in I would say in an accurate way, or it's an evolving way, right? And you sort of have 2 steps forward, 1 step back. That's the scariest scenario, is you really don't finish in time. I think I'm going to go back to my earlier point around timing. I get this, or perhaps there's a sense of oversimplification of how you're going to handle data by the management team that's doing the deal. right? They're like, well, we'll figure it out. We'll create some mapping spreadsheets, and that'll be the Rosetta Stone we'll use to sort of integrate these businesses synthetically from a reporting perspective, as Joe just described in one of the scenarios. That's not just because you're mapping accounts to accounts, products, brands to brands, products at various levels of your operations, doesn't mean it's a trivial exercise. That in and of itself can take months, and then the maintenance of it and creating the stewardship around those. You have two sometimes very large going concerns that are constantly evolving. So by virtue of the fact, on day one, there might be something accurate that's aligning these things, it's allowing you to operate them as slowly but surely merging entities, right? But in fact, they're changing over time. So this kind of slowly changing nature of all those mappings, ignoring that can get you in so much trouble down the line. And in fact, can result in ill-informed business decisions. You'll start thinking performance is one way when in fact it's another. Or profitability is the biggest. It's like you start to lose sight of the detail around profitability, and you might actually be doubling down on products or services that just are not as profitable as you think they are. So there's some real perils at trying to handle this. Now that doesn't occur if you do a full-blown integration. You do it the hard way and really build it from the ground up data-wise. You don't have those same challenges. But the scary thing there is the level of effort. If people have underestimated that, boy, you have a bigger hill to climb.
I think the number one thing is that the like you said, the effort that it takes to integrate the data between these two entities is 100% of the time underestimated.
Yeah.
And also, the resources that it requires and the types of resources that it requires is usually I think, one of the data integration, because data is just so important to every business now, it needs to become like part of the diligence process and really estimate what is the effort of this. Because it is so big, generally what happens, like you said, Danny, that they typically either do it like small, quick win, right? Or they try to boil the ocean. And I think that the key to this is really understanding what it is you're getting into, what is the roadmap, and be very thoughtful about how you get there. Because it's usually a multi-year effort, but you can't wait multiple years to see if this transaction is actually effective. Is it profitable, right? So you need to be able to plan large and map it out and then build small so that you have all the information you need almost immediately, right? All of the financials, all the things that you are using as indicators to know whether this thing is right or wrong and how to course correct. And then over time, slowly backfill all the other information. So then by the end of the journey, you have a fully integrated data platform between two entities.
Do you want to chime in on that further, Danny? Real quick, you had something.
Well, yeah, sure. I was going to say one of the things that actually can really help and facilitate this process, and I will tell you, it is probably the thing I've in my career I've always pushed for. I very rarely got it. Is having at least one of the entities having a very healthy data platform. One of the challenges I've seen is if one, or in many cases both, don't have data catalogs, real understanding of data lineage, good data standards, really great data definitions, understanding KPIs, and being very kind of religious about keeping the hygiene up. That notion of dealing with two moving target, trying to kind of, it's like aligning gears that are constantly moving and shifting. The grommets never, the gears grind, right? In the best of circumstances. In the worst, they break. And I think that's exactly that, having at least one of them have a good steady state that you can predict and say, we can live to the standards that are defined here. And if we can align, say, the acquired entity to the way we've defined it, we'll be safe. because we'll know that this isn't, someone's not going to be taking it and going marching off in the left field with a data definition or a new, they're starting to ignore some hierarchy or something in the acquiring entity. So that's to me, sometimes if your house is in order, your own house is in order from a data perspective, it can be a big leg up when you are actually doing the acquiring.
All right, that's one. Joe, you can chime in. It's all right. We have one more minute.
I just want to say that modern times are making this a little bit easier. I don't know of any products out there, but I know that internally we are building things to help this, because back when we did this stuff together, it was all manual, right? We were like looking at codes, doing the mappings, Excel spreadsheets, right? Getting it all in order before we actually systemized it. But now with machine learning, looking at data, finding outliers, finding anomalies, figuring out what should be aligned and what shouldn't be aligned. That's what machines do best. Like, they're way better at it than humans are, right? So building some algorithms to go through all of your data and come up with those mappings it will expedite this process in the future, for sure.
Great point.
All right, that's all the time we have for today. Thank you so much. That was wonderful, Joe. Wonderful, Danny. And to our audience, if you have any questions about your data strategy in an M&A, I encourage you to talk to us. Thank you so much, and I'll see you next time.
Thanks, Remy. Thanks, Joe. Take care.
Yeah.